Hi, good morning, everybody. Thank you all for joining in. We'll just wait for a couple of more minutes for more participants to join in. And we'll start in about 5 minutes. Yeah, yeah. All right. Thank you. Thank you so much for waiting up. I know that there's a little bit of delay, some technical issue that is happening. I had to restart and do a lot of things, but thank you all for waiting up. So this is so we realized that there's a lot of demand for Tamil, and I'm usually not someone who can get the language very well. So this presentation for you will be completely in Tamil. So if there's any issue, just let me know if there's something you face with the fonts and with the design if there's anything. And I will talk to you in English, but the presentation will be more or less in Tamil. So if my translation gets here or there, please don't worry. Content remains the same. Yeah. So okay. So this is the same thing that is going on. Okay, title not visible. That was my issue. That was the technical issue that I was facing. Right? Just hold on then. That was the technical issue that I was facing. Hold on. Okay. Yeah. Now, is it better? All fonts coming, everything looking good? Give me a thumbs up. Yeah, perfect. Thank you so much. Okay, so this is the same thing that is going on, on the Tamil webinar. So we thought that we'll try to do something different, where the audience usually says that we want the presentation to be in Tamil, but so I would be choose speaking in English, but for your benefit, it will be in Tamil. Yeah. Okay. So what is an SIP? SIP is like your RD, it goes continuously. So I don't need to even, spend a lot of time explaining, because today in today's market, you look at the SIP number is somewhere around 25,000 odd crores that is going in every month, right? Beauty of this is it can go daily, it can go weekly, it can go monthly. Right. So I know for a fact that in your Q&A, you're definitely going to ask me saying, is it better if I do a weekly SIP? Is it better if I do a monthly SIP? Right? No, it is better if you do a if you be consistent, right? Weekly, you can do STP also. There's nothing specific to that. So definitely, I would suggest that monthly would be the best way for you. Daily, I don't think it is suitable at all. Small sums not going to make that much of an impact. But yes, it is like your RD. You just put in for it, right? But monthly, I would say is the best option for all investors, right? So how much of SIP should I do? Now we have this in the presentation where we are going to talk a little bit about savings rate. How much, what is the maximum I should be doing? That depends on your income, that depends on your expenses. That's why it's very important for you to get a good hold onto your savings rate. So how much of an SIP should I do? Definitely, it should be the maximum of what you can do from your side. Why we tell you, that you should be willing to save a lot more is because it's difficult in the beginning to get into a financial habit of being consistent, right? Because there are expenses that come into place, and usually when you're having a lot of money, the first thing is that you get confused as to what you want to do. So build some discipline, have some amount of consistency, and strive to do more. Right? How long can I run your SIP? Right? See, you don't need to put a date, right? Your SIP should always run. There is no there is no bargaining when it comes to running an SIP. Your SIP should be running for a very long period of time. Next question. Where should I be running my SIP? Right? That depends on your risk profile, that depends on your goal. But ideally, you should not stop your SIP unless and until there is a deep issue that comes in your finances, right? That means you have to first fix your finances, and then only uh, look at touching your SIP. But how long you should run your SIP? Ideally, you should not stop contributing towards a particular uh, you know financial asset. Now, how many MFs? I hope I'm getting this right. How many MFs should I do SIP in? This is a question for you. How many MFs are you currently running an SIP in? How many MFs or how many mutual funds are you currently running an SIP in? You can put it in 10, all right? 10. Anything else? Any other answers? 7, all right. So for 7 mutual funds, you're running SIP, all right? Let's take it one notch up. How many active, how many passive? Okay, right. That's the answer that I was looking for. 4 sector, 4 equity, 1 gold, and one, I'm guessing one is global. I'm guessing one might be global, right? Okay, right. So there, yeah, global, Nasdaq. All right, understood. Right. So this is This is what I'm talking about, right? When you do a lot, naturally you think that it's getting diversified, but in reality, it's not getting diversified. It's diversifying, right? So when we look at doing SIPs in mutual funds, see, mutual funds are a basket of stocks. They usually have about 40 to 50 stocks. And if you see within the benchmark, they will have either BSE 200 or Nifty 500 as a benchmark, which again has overweight is overweight on banking, and then you'll have IT, and then a little bit of pharma, and the list goes on, right? So there's a good amount of overlap when it comes to doing equity funds, right? And that is a complaint that we keep getting a lot, that there's overlap. Yeah, there is overlap because you're buying a basket, and that basket is linked to a particular benchmark. So naturally, you have to go active. You have to have an a high active share to your particular benchmark, right? So having it diversified across small, mid, flexi, large, yes, that works. Or you can have a concentrated approach of just doing two things that are very, very similar and complementary in nature, and top it up with sectoral funds, right? Sectoral funds also sometimes might be similar, but the thing with sectoral funds is that you have to get the cycle right, right? So I would say a maximum of 4 to 5 is good. I would say that is the best case, right? 4 to 5 is very, very good. I would say 5 to 7 is base. That yes, there might be certain themes, there might be certain sectors where you have to take that particular, and we have taken that particular gold call as well. And no, nothing to do for global, nothing to do for multi-asset or hybrids, where the product is not very efficient, right? Unless and until you have a particular goal which is conservative in nature. But if you're having an aggressive risk profile or a moderately aggressive risk profile, then your allocation should be more towards the equity part, and some should be diversified towards precious metals. So yes, 5 is very, very good. 5 to 7 is on par, its pace. And anything above that is a review where you have to see, it's not that the number of funds matter, but it matters that when you go beyond a particular point, it matters as to where the money is going. If the money is going in the same place again and again, then it's a very big review, right? Then it's a very big review, right? Okay. What is a good savings rate? So now I want to know from your current, uh, expenses versus income, what is your savings rate, and what you think is a good savings rate? Okay, that's very good. 50% is a very good savings rate. 50%. Okay. Any other comments? 50 is a good rate. Right. So usually when you have a savings rate of 50, 60, and 70, 70 is very good. You should strive for 70. And Milestones to Wealth, the investors that we work with, when they come, with a lot of uh, there's no direction on what they wanted to do, but they got into the market because of how things have been since 2020 to 2021. First idea is to get them to have a very big savings rate, a large one, somewhere between 65 to 70%. 70%. Now what happens is, you're assuming a 5% growth in your income every year, and you're growing somewhere between 12%, right? That means that this actually answers to your step up also, which we'll get to later. But the whole point is that over 20 years, like 15 to 20 years, your portfolio growth will be somewhere between 68 times to 70 times that of your annual expenses. Like, the whole point for you to have a higher savings rate is so that you're able to, one, contribute to the right places. Second, make sure that in the future your expenses are covered, and the growth that you have on top of that is very well covered, right? So 50, 60, 70, right? assuming that a 5% growth in your income, right? That your income is growing by 5% every year, and your portfolio from a CAGR perspective is growing at 12%, right? So 15 to 20 years, right? That is your long-term horizon, right? So your portfolio growth in comparison to your expenses is somewhere between 50 to 75 times. So your growth covers for all your expenses. That's why we tell you to strive between 60 to 70%, and 50% is very good. So you're very well covered. So you have to strive for 60. Once you reach 60, you have to strive for 70. Right. And that can take place when you have your if you have certain liabilities, the liabilities get paid off. Naturally, you get a very good savings rate. Right. Naturally, you very good get a very good savings rate. So 50, 60, 70 is a very sweet spot. Above 70 was then you're home, I think. So just continue doing whatever you're doing right now. Make sure that there's no that your lifestyle is maintained the right way. There's no splurging of money that takes place. Like 50, 60, 70 is a very good. If you're at 50, strive for 60. If you're at 60, strive for 70. Right. And we will help you do that. We will try to understand where most of the expense is going. If it's a lifestyle related thing, yeah, then it can be a little bit of a struggle. But any other thing where you're having a liability, where there are certain expenses that are not going to be working out in your favor, suppose if there's some capital misallocation that is happening from your household wealth, we will fix that so that we can get you in that range where you're able to cover over 20 years, we're able to cover your annual expenses. Right. Okay. Uh, should I do a SIP or should I do a lump sum? Right? Okay. So it has to be both. Right? See, being consistent is a separate behavior, and making sure that you're able to participate, uh, at the right time is a separate behavior. Right? SIP has to be very consistent on your part. So there is no, I will stop my SIP, I will wait for 3 months, that money I will give you as lump sum. It doesn't make sense. It's the same thing. Right. See, the goal for you as a saver is that you need to grow somewhere between 9 and 12%. This is base. 12 to 15% good. 15 to 18 is very good. Right. That the difference between that, where you have an investor making 18% versus that of an investor making 15%, has nothing to do with what he bought or what he sold, but it's that gap which is called the behavior gap. See, today information is readily available to everybody. What I'm seeing is what you are seeing. What you are seeing is what I'm seeing. Same way, right? It's not that we have different, it's the same thing. Information has become accessible. Things, your newspaper is there, you're having so many YouTube channels, we're having so many groups. You're all part of something or the other. There are events that are taking place everywhere. There's Twitter, social media, right? So there's a lot of information that is outside. So in this day and age of high information, the only difference in how you can beat another investor and beat yourself over in your course of history is by making sure that your behavior is on point, right? So the do's of an SIP, the biggest do's of an SIP comes from the point of, yes, I will run the SIP continuously. I will not make any changes to my SIP unless and until I need to do a step up every year, which is why your savings rate is going to contribute to your higher savings rate will contribute to a higher contribution to an SIP. And there are years where sometimes you get a bonus during Diwali, sometimes you get a bonus at the end of the year, sometimes you get a bonus at the end of a financial year. Whatever your tenure for bonus may be. So that becomes a good opportunity for you to do an option. Right, at that point, topping up onto your SIP portfolio will help you reach that 1 crore target much faster, right? Because you're able to contribute to that. The whole point is that you need to contribute, you need to participate. Growth rates would anyways come, right? If we are able to be rational, which we are as wealth managers, where we are being rational as money managers, 9 to 12% is what you can expect out of equity. 12 to 15, that is, a good case. Right. So don't think too much from a perspective of what you should buy, or say no, I want to do direct stocks, I want to do this. No. Your only point should be how am I going to get my behavior right? and make sure that my savings rate is on point, somewhere between 60-70. Right. So run the SIP, continuously keep doing SIP. When a chance comes to you for step up, yes, step up should be an option. But right now, run the SIP first. Whenever you're able to get, big chunks as bonus, some deal cracks, something that comes to you, that money you should definitely put as a lump sum. Right. So it has to be a mix of both. This is going to be very impactful for you in the future because you're able to participate more at periods where there's a problem. You're able to get more and more units of it, right? And you would have gotten from us, if you're on the Milestones2Wealth program, you would have gotten messages from our side, from a from a behavior orientation as to where you should participate, what we want to do for you. And there are one-on-one conversations that take place. So there's a lot, that we are doing from our part to make sure that that gap for behavior is being filled. Right. How much should I step up? This answer is simple. So when was the last time you stepped up your SIP? Right, I'll ask you a question. When was the last time you stepped up your SIP? Number one. Second one, in relation to that, how much of a percentage of your SIP did you step up? Let's say you were doing 10,000, you added 5,000 more, so it's 50%. So you can put 10, 15,000 stepped up last year, and it was 50% of what I did. No, when was the last time you 3 months back, 15%, good number. 3 months back, you stepped up, good number, 15%. Any other comments? Nothing? All right. 15% is a very good, right? Sweet spot is 10 to 15%. Right? When you do an increment of 10%, you are able to meet a crore within 10 years if you're doing a 30,000 rupee SIP. 10 years, and the next incremental crore comes to you much much faster as you be consistent with your investments. See, when we say 1 crore, we are actually setting that target for you for 10 crores. So within that 23 year period, while you're being consistent for a great 10-year period, and you're able to compound at healthy rates, plus you're doing a 10%, 15%, 10 to 15, be reasonable, 10 to 15% sort of because over a long period of time, when you do after 10 years, 15 years, it becomes difficult for you to maintain that 15%. That's why I say, do you look at it from an income perspective where as your income grows, you're still able to maintain somewhere between 60 to 70%. So that extra is what you're able to feed always. That extra is what you're able to feed, right? Okay. Advantages of doing SIP. See, there's good amount of professional management when it comes to mutual funds, right? There's a proper team, there's an investment committee, so you don't have to worry too much about doing SIP in a particular mutual fund, right? There. So you are able to next regularly save, right? You're able to cut out any behavioral bias because here you're always going to be waiting at the side thinking, what should I do? What should I do? Should I invest? Is it the right price? What if it goes down further? And create a lot of anxiety within your own self. That doesn't make sense. Right? This cuts out any behavior bias to say that uh, you know, I will just be consistent, not seeing, what's been happening in the market. The only thing that you're going to be seeing is when do I need to step up, when do I need to do a lump sum. That's one thing. Cost averaging, yes. Uh, Assuming in a sideways market, your a bulk of your investments goes at a particular level, which is going to work for you when things get a lot more better. Everything is a particular cycle, and when you're able to capitalize on a period where things are not doing well. So when the things do very well, this particular strategy works in your favor very well. Look at how a power of a 3,000 rupee SIP also can do. Look at, in a bad phase, what's been happening, right? You look at what's been happening, right? So you're able to buy more and more units when it's at a lower price, right? And as things start to do, the value of your investments start going up, and naturally the units also start going down. But the whole point is for that 1 to 2 years, right? From 2 years where you've been able to average at lower levels has worked in your favor when it comes to a high. So that's why you say that you need to have a long term horizon when it comes to being consistent and being rational as a saver. So here you go. Without breaks, with the break during a dip. Look at the difference when you don't break your SIP at all. Right? When you don't break your SIP, this is from last 3 years. When you don't break your SIP, it's 22.5%. But if you break when it's a great time for you to be doing, yeah, the returns seem to be high 16. But the whole point is look at the behavior gap. That's the difference between you and somebody else, right? That this is the behavior gap that we were talking about. So in a long term period, this matters a lot. This is what is going to make you stand apart from the rest of the crowd, right? So no break is very good. Break, assuming that there's a different scenario in terms of your finances, if there's some issue that comes, see, that is fine. But if you do it for some expenses which we'll get to, then it does not make any sense at all. Right, so look, this is just 3,000 rupees. So you're doing very well in terms of without a break. But with the break, definitely there is a direct impact of how much you're able to earn. Now, okay, these are your don'ts. Okay, I have some certain expenses that are coming up. I think this is the translation. Should I stop my cycle? No, right? Depends on what the expenses are. But if it's a medical expense, it's not that you need to stop. We need to plan for that way ahead. That's why we say that insurance is a very important part of your financial wealth journey, because it is going to protect you. It's your first layer of protection, right? Only then you will be able to take risk. Otherwise, you lose out behavior here as well. You will lose out behavior here as well. And at the end, you don't compound at very good rates. And by then you struggle when it comes to retirement after the 10th, 12th year. Right? But the whole point is you can avoid this sort of scenario when you have expenses by actually planning in advance and having contingencies in place. So make sure that you have a term, make sure that you have a health, right? When you need to maintain at least 6 to 8 months of contingency expenses, always. It's a given. It's not something new that is being told. It's a given, and this is something that you can learn from the previous generation as well. Where yes, today medical inflation in India is quite high, and it will continue to get high. And hence, you can be prepared rather than stopping your SIP. There has to be good contribution that goes for your insurance, particularly term and health, and then naturally have 6 to 8 months of your general expenses, in a liquid fund, in an arbitrage fund where you can do SIPs in that way. You're planning for your expenses, right? So the whole point is for you to make sure that you don't stop contributing towards asset creation. You do not stop creating in that because it's a long journey. So naturally, you cannot stop that, but you need to plan for contingencies in place. So make sure insurance, make sure contingency money, right? Okay. Now, this is a goal that you need to save for. This is not something that you need to stop for. So we do work with investors who have a vacation goal, and that money usually is being conservative. It goes, to somewhere of a liquid arbitrage. You need to save for a trip. You don't so have a split up of the goals that you have. And when we look at the split up, and when we look at okay, this is your savings rate, and this is what has to be contributed for that particular goal, depending on the target for that, depending on the target corpus, you plan for a particular goal. So if it's a trip, it's a vacation, do not stop your current contributions. Come on, save for that particular contribution, save for that particular goal, right? And then use it, and then that thing keeps on working for you because you're continuously being consistent on that as well. So you can take better trips at the same time, you can take bigger trips. Right? You can, and this is a very essential goal. I think traveling if it gives you mental peace, it's a family vacation, it's a good time. So save for that goal. Do not stop your current SIP to meet that expense. So here you're losing out on buying more units and compounding for a long period of time, and you're spending more as well. So you don't create anything, right? Okay. Thematic funds are doing very well. Should I stop and change my SIP and move towards a thematic fund? No. Just because a fund is doing well doesn't mean that you need to stop your particular fund. It's a cycle. Everything works in a particular cycle. Right. So PSUs and defense and infrastructure worked very well from 2021 all the way up until 2023. That doesn't mean that because 3 year returns, right? Because 3 year returns and last 1 year returns are good, I need to stop my current contribution to my fund and move to that. So stop chasing performance. There's no chasing. So the gain out of chasing performance is nil. Right? Where you can make 9% if you just be equal on asset classes and don't do much. There it becomes 7% if you start chasing. And all of this is public data. This is something that is published by Bandhan of on their multi-asset presentation. So you can check it out. There's no, it's not something that we are seeing. It's all published data, right? So just because something is doing well, be it a thematic fund, be it a sector fund, right? It doesn't matter, right? Don't chase performance is the main criteria here. So don't stop your SIP just to move to another part that has done well, where you have to chase it and overpay for that particular idea, right? So you're buying higher units. I mean, you're buying units where it's at a higher price, right? So when there's a problem, you don't have a good experience out of it, right? Right. I think now think we have a good. So if you want to know more about the do's and don'ts, right, just send us SIP to our WhatsApp number. So we've created an SIP handbook, which is very interesting. So just send us SIP and we'll message you the handbook. So you can do it. You can just send us a hi on the Milestones2Wealth number, and we've prepared a SIP handbook where we are talking about in depth about more do's and don'ts with a lot more data. So just send us a message saying SIP and you'll get the handbook. Right. Okay. Now I think we can open the floor for Q&A. Right. So if you're not on the program, just get on to the program. You can still put in your questions. Okay, presently you're doing a SIP in infra, IT and pharma. Can you suggest any other sector or fund? Can we sit one-on-one? If you're on the program, you can just send your portfolio to your point of contact. And if you're not on the program, also just send us a hi. Somebody will be in touch with you. But we can have a conversation one-on-one, right? We are doing sector, we are doing theme. The whole point is that it's not that we have to force to do a particular sector or thing. When it makes sense, we are doing it. See, our endeavor, right, on Milestones2Wealth is make sure that we take care of the investment conviction and we take care of giving you that options for scale, right? But growth mindset is something that you will see over a period of time where you yourself need to develop that. Financial discipline is your consistency, and this wealth map is what I was talking to you about, making sure that you have a direction on your savings rate and your potential to save more, right? That will give you clear direction. That's what the map is. It gives you clear direction. Right. So this is what the program is doing. So we can do this for you. Just send it to a point of contact. We can review it. Okay. How to do asset allocation for different classes? See, depends. See, we do tailor-made solutions, right? That's why we sit with you one-on-one. The wealth map gives us a clear direction on what we need to do, right? So we will do all this for you. Make sure that first, before we get into asset allocation, we need to see if you're under insured or over insured. That's number one, right? So we review that, make sure that you're if you're lacking in something, give you more of it. If there's something that you're overpaying for with lesser benefits, make you stop that and get you to a place where there are good benefits with what you're paying. That's number one. Second, uh, we make you take a risk test, which is basically a risk appetite, right? So the risk appetite is different for each individual, right? Then we look at the goals that you're having. Only then we create an asset allocation for you, right? So it's not 80-20 or a 60-20-20. It's nothing like that. It depends on you. It depends on what your financial condition is. It depends on what your goals are, right? That is how we are doing asset allocation, and that is what that is the right way. There's no one size fit all. It is what makes sense for you. We will do only something that makes sense for you. Right? And there is a particular team that does this. There is planning that guides us. Uh, then there is strategy that does the work in terms of where we can invest for you and gives you that sort of direction. But it's not one size fit all. It is tailor made for you. Right? How to contact you? This is the number. You can just send a hi on this number, and somebody from the team will get in touch with you. I'm doing corporate NPS, which is kind of SIP. How to step up a corporate NPS. We help you. Don't do anything to your NPS. It please let that run. On top of that, we will do mutual funds for you. Then we will do some sort of uh, contribution that has to go towards the active dynamic asset asset class equity. So we will do it for you. The NPS let it run. So we'll plan for that. Just send a hi and somebody from the team will get in touch with you. We'll make you take the wealth map no, to see where your income, where your assets are, and if there are any liabilities. We'll do all of that to give you a proper direction in terms of what we need to do. What is the formula rule for finding the saving potential of an individual? See, it depends on the individual. Sometimes, right, you have 30-40%, which is low. So how do you strive, to do more? Is it more from an income standpoint or is it more from an expense standpoint? Your income might be high, but your expenses in relation to that also will be very high. So your savings rate just is low, right? So you should look to do somewhere between 60 to 70%, right? So the potential is always there to go higher. For 70% also, you can go higher, right? So it depends on the income, but depends on the expenses. But you know, there are some cases in which liabilities eat up a lot, and priority should be to pay off the liability so that you have more to save. In that sense, the savings rate just goes up. So we'll help you do that. It's a very simple calculation, but we'll help you do that. It's not about the formula. It's about what you need to consider as an expense and what you need to consider as a liability and what you need to consider as an asset. That's where we come in. Okay. Should we split the SIP across market cap based funds or invest in one flexi cap whole amount? One should choose momentum funds. Why should you see the point is that when we are recommending itself, just do very basic, simple, boring things. And so for example, uh, on 1st January 2018, and we did this I think this exercise we did last year. It was published. We did multiple webinars on it for asset allocation and momentum. Uh, so let's say you put money on first as a lump sum. First January 2018 in small and mid caps, small caps, when it was at its peak. What would your return be after 6 years? Okay, you tell me that answer. You can calculate. You let me know. Should we consider home loan EMI as investment? No, you're wrong. It's not 18%. Lump sum means nothing up, no contribution after that. 6 years later, that is 18, 9. So 18, 19, and 20 were periods where small cap from that peak did not even reach its peak back again. It reached its peak only in 21, right? Then again in 22, you had some more performance that came in from that side, but you started investing in 2018. So 6 years, your CAGR is somewhere between 4.5 to 5%, peak to peak, right? So when you're doing SIP, yeah. So when you're doing SIP, right? We don't look to say no because we need to have a diversified approach. We will do large, mid, small. No, what makes sense in terms of valuation to do, we would do that. So, for example, last couple of years, there's a particular theme, particular sector that is completely undervalued. So naturally, we would do more and more part. We would like for you who has a aggressive risk appetite, for example, to participate more and more into it. So it works for you. Last 2 years only you've seen big return that has come in. But you, as a saver in India, have a 10-year plus horizon. So 6 years out of your 10 years, if you're doing lump sum and just leaving it there, just leaving it, right? That's what they say, buy and hold, right? Just leaving it there. What happens? Because 60% of your wealth creation journey is growing at very subpar CAGRs. SIP different, but the whole idea and the mindset is that yeah, one we have to see it's long term. Second, we have to see that we are working with investors who require that level of hand holding and consistency, uh, you know, in terms of contributing. And third, our job is to make sure that wherever we are, suggesting or recommending has to be there has to be enough margin of safety in that particular theme or that particular part. Like, it's not as simple as okay, I'll do all of this, I'll do this, and I will compound. That you'll anyway compound in between 9 and 12%. Your job is to do more. Right. This is the number. Get in touch with us. Send us a hi. Somebody from the team will definitely get in touch with you and make sure that we do a wealth map for you. We make sure to give you good amount of direction so that we make sure that that saving rate is achievable. Thank you. Thank you so much for joining in. I'll see you all. I think I will see you all next week again if you haven't registered. But you'll get all the invitations if you're just send us a hi. You get straight away. You get onto the program, and I'm hoping to see you all next week. Thank you so much. Have a great day ahead.